Hi, Megan. Could you kind of introduce yourself and let us know what you do and how you work for Blue Owl?
Sure. Hi, David, and hi, everyone viewing the video. Great to be here. I'm Meghan Donoghue. I'm a principal at Blue Owl based in New York City, and I work within our portfolio strategy group, leading our real assets portfolio strategy business. So, sort of sitting straddled between the investment team and more of a client-facing resource to make sure that we're delivering the most up-to-date, in-depth, where necessary, resources related to all of our real assets, but with a specific focus in the net lease space, which I think is what we'll talk mostly about today.
Yeah, perfect. So I think the first thing, sometimes it is a slightly challenging kind of area. Can you give a brief overview of triple net lease and how that works?
Yeah, absolutely. I mean, real estate is this monolith that we use to describe a lot of different things, right? There are all sorts of different sort of sub-strategies, asset types, geographies, and within Blue Owl, we really focus on one kind of real estate, which, as you said, is triple net lease. And very simply, a triple net lease is just a lease structure that we use to create the best visibility that we can have into the future cash flow that our assets will generate. And the way that it's done is that through this lease structure, our tenants become responsible for all of the operating costs of the real estate. The triple are the three costs. So it's property taxes, property insurance, and then all maintenance and repairs and capital expenditures. These three costs you generally associate with being a landlord's responsibility. And yet through this net lease structure, that is transferred to the tenant. And in doing so, we really improve our visibility into what the net cash flow of these properties will look like over time and transfer a lot of the traditional risks of real estate ownership to our tenant. Our primary risk through this type of lease structure becomes who is that tenant? Because those costs still exist. They tend to go up over time because they're very linked to inflation. They can surprise you, and so they're still there. And we need to make sure that we have a tenant in place that we have a lot of confidence will be able to actually withstand them. And so we focus on structuring these net leases with high quality corporate counterparties as our tenants, typically investment grade rated companies. And then once we have this great lease structure and a strong tenant, we want to keep that tenant in place as long as we can, using typically about a 15 to 20-year lease and just stretch out, excuse me, this very predictable income stream that we've been able to manufacture. So that's what we do. I think the benefit for an investor of having a net lease allocation is sort of twofold. The first is relative to traditional real estate, given our visibility into the future cash flow that our properties will generate, we generally pay a higher distribution. That distribution is highly tax efficient, which is a big reason that attracts high net worth investors to the real estate space in the first place, is that a vast majority of the cash flow coming off of these assets is generally characterized as return of capital, which is not taxable as you're receiving it. And so we pay right around a 7% annualized distribution, which is, call it 30 to 50% higher than most other real estate funds that operate structurally similarly. The second benefit is just as important, I would argue, and has been quite obvious over the last couple of years. As you said, it's been sort of a challenging environment in real estate. When you have this visibility into your future cash flows, inherently that creates stability for your asset values. And that's just because real estate valuations, like most assets, are going to be some sort of net present of future cash flows. And we don't make a lot of assumptions about our future cash flows, right? Long-term leases, high quality tenants, zero operating expense exposure, fixed annual rent growth. We know almost to the penny what our cash flow will be for the next, 15 plus years. And so we don't have to go back and adjust those assumptions when the market environment changes, and in doing so creates volatility in asset values. So we've generated about an 8% annualized return over the last 2.5+ years amidst an environment where most other real estate managers have been sort of flat at best.
Yeah, that was actually my next question. So that's perfect. And then, I think looking forward, Megan, can you touch upon how the fund has kind of repositioned and with respect to data centers as well?
Sure. Yeah. Importantly, often when I've described this lease structure, investors might say, that sounds really nice for Blue Owl, right? Not having to cover all these costs, but what's in it for these great corporate counterparties? Why do they agree to cover these expenses? And to me, that's maybe the most unique thing about what we do. The way we source assets is these really aren't just real estate trades for these companies. This is a capital solution that we provide them. And there are two ways in which we can provide this capital. The first is if they have an existing property on their balance sheet, they can monetize that asset to us, uh, sign a lease to remain the tenant in the building. It's called a sale leaseback. Unlock the value of that hard asset on their balance sheet, which really is not earning them anything. If you're not in the real estate business, it is a non-earning asset for you. And by operating under a net lease, they're able to retain substantial control over that property, have, great visibility into what their future rent looks like. They retain the you know responsibility for the cost of operating the asset as well, but that's okay with them. They already cover property taxes, insurance, maintenance, repairs for assets that they own. So they're comfortable with that. And what they really view this as is a way to unlock that value and redeploy that capital, whether it be 50 million, 100 million, $1 billion in cash into something that's more accretive to shareholder value than nothing, which is what their real estate is earning them. So, as you can imagine, over the last couple of years, amidst a higher cost of debt and lower availability of debt environment, this has been a really compelling solution for CFOs and treasurers to consider as they think about financing their just sort of ongoing capital needs. The second way that we can provide capital is quite similar, but it's actually for assets that don't yet exist. So, sometimes companies have a need for a new property, and yet in the same way that they don't want to own it on their balance sheet because they understand that it's not the most efficient use of their shareholders' capital. And where we're seeing a lot of demand in this space right now is in the data center space, as you described, right? The largest technology companies in the world, Oracle, Microsoft, Amazon, have sort of insatiable demand right now for new data center assets, on the back of significant increase in cloud compute capacity and AI needs, right? And so what we're able to do is either finance the build and then ultimately be the landlord of these assets that are pre-leased to these really strong companies, some of the leading technology firms in the world with great credit quality, have 15 plus years of cash flow attached to these assets at a meaningful premium to that same company's corporate debt. And that's really how we're always looking to structure these assets is, what kind of yield premium can we get versus that same company's corporate bond of a similar duration? Because our risk is actually quite similar to those corporate bondholders, right? As long as that company doesn't find itself in a bankruptcy situation, we will collect our rent. And if we can out earn those bondholders while having a hard asset as collateral, and by the way, one that we think is very attractive longer term in the data center space, that feels like a really good risk return opportunity. So whereas historically we've been able to generate, call it about a 200 basis point yield premium relative to the corporate credit of these companies, in the data center space today, we're seeing more like a 300 to 500 basis point yield premium. And most of that is just driven by the reality that the quantum of capital required by these companies today is so significant that the pricing is very, very compelling. So this is an area where you're going to see us doing more and more business. This will never be a data center fund by any means, but do I think it will be a 10, 15, maybe even 20% allocation within the portfolio at some point? Yeah, I think it could, just based on where our pipeline is today.
Yeah, and in relation to that corporate bond as well, it's also tax efficient. So,
Yes, absolutely. Yeah. I think sometimes the easiest way to compare the exposure through our strategy versus a corporate bond is that as the landlord, which is really what we are, right? We get paid first because rent is an operating expense versus, bondholders, which would have to be, second in line, basically. We get paid more, right? As I described, we've been able to generate this premium in yield relative to bondholders. Our cash flow stream is secured. we own this hard asset as collateral. That protects us on the downside. It also means we can have some upside over time versus bondholders, which are unsecured and upside is really par. And then fourth, our cash flow stream is meaningfully more tax efficient relative to bond coupon, which is going to be all ordinary income.
Yeah, that's great. And I mean, we see this as an income focused type strategy, but these assets can appreciate as well, right?
Yeah, they absolutely can. And, given the way that we source these properties, and as I described, it's really not just a real estate trade for these companies. They're really considering what's the higher and better use of this dollar. Historically, we've been able to acquire assets at about a 20% discount to their market value, which is important because not only would we like to monetize that discount at some point, right? And in doing so, generate some upside. But it also means that the market can actually get worse and we can still meet our base case returns because we're coming in at such an attractive basis in the real estate on average. So, I think it offers that downside protection, but also the possibility of some appreciation over time too.
Right. Meghan, thank you so much. That was fantastic.
Thanks for having us.